Most people have no idea they're losing tens of thousands in hidden fees and slow growth funds. I didn't either until I ran the numbers on what my investments really cost me. Before we dive in, quick note, this video is for educational purposes only and not financial advice. Always do your own research before investing. By the end of this video, you'll understand why so many investors unknowingly follow strategies that quietly reduce their long-term returns, and I'll show you a smarter, simpler approach that could seriously boost your results, all without flipping your lifestyle or quitting your job. Here's what most people don't realize. The investment industry collects over $100 billion a year in fees, and many of the products sold are structured in ways that quietly eat into our returns. The result? You work hard, invest, and still wonder why your portfolio isn't growing like it should. What most people don't realize is that ETFs, mutual funds, and index funds aren't just ways to invest, they're also business models. Each is structured differently, and depending on what you choose, it could quietly impact how much of your returns you actually keep. Each investment type serves a completely different purpose, has vastly different fee structures, and is designed for entirely different types of investors. When you choose the wrong one, you can lose tens of thousands of dollars without even realizing it. Let me break it down exactly how each investment type really works, who they're actually designed for, and why most people are using the wrong tool for their financial goals. But before I dive deeper, hit that subscribe button. It encourages us to create educational videos like this. Let's start with mutual funds, a popular choice pushed by many financial advisors and trusted by millions of investors. But there's a lot most people don't see behind the polished brochures. A mutual fund is like a large basket where thousands of investors pool their money. A fund manager, often with years of experience, decides how to invest it, usually in a mix of stocks and bonds. In return, you pay a management fee, often around 1.25% per year. Let's break that down. If you invest $1,000, that's $12.50 gone annually in fees regardless of performance. So they're investing $987.50 of your money while still collecting their cut. If the fund performs well, great. If it doesn't, the manager still gets paid. The investor takes the risk. The fee stays the same. According to long-term studies, many actively managed mutual funds have underperformed the S&P 500 over the past 15 years. It's not always because the managers are bad, it's often due to cost drag, the cumulative impact of fees over time. And those fees aren't always obvious. There are trading costs, marketing fees, sales commissions, and other administrative charges. In some cases, your real cost could exceed 2% per year. Investing $6,000 a year for 30 years at a 7% return, a 2% fee could cost you over $200,000 in lost compound growth. That's the kind of money that could help fund your retirement or pay off your kid's college gone, just in fees. So it's worth asking, are mutual funds optimized to grow your wealth or to support the financial institutions behind them? Mutual funds tend to favor investors who have more money than time, those who prioritize convenience over cost, and who don't mind paying a premium for the chance to outperform the market. For many high net worth individuals, a slight underperformance may not be a major concern, but for everyday investors building wealth steadily through monthly contributions, fees matter a lot. Every dollar paid in fees is a dollar that misses out on years of compound growth. If mutual funds are your main investment tool, it's worth asking, are you truly getting value for what you're paying? Statistically, many actively managed funds underperform index benchmarks after fees. So in many cases, you're paying more and potentially earning less. Now let's talk about ETFs, exchange-traded funds. They've exploded in popularity over the last 2 decades, largely because investors got tired of high-cost mutual funds and wanted more control, lower fees, and better transparency. An ETF works similarly to a mutual fund. It holds a basket of assets like stocks or bonds, but it trades on the stock market just like an individual stock. That means you can buy or sell ETFs during market hours, rather than just at the end of the day like with traditional mutual funds. Most ETFs have very low expense ratios, often around 0.2% or less, which is one of their biggest strengths. But despite all these benefits, there's one hidden challenge. Because ETFs are so easy to trade, investors often monitor their accounts constantly, which can lead to poor decision-making. According to research, the average ETF investor underperforms the ETFs they own by nearly 1.7% annually, mostly due to emotional timing decisions like buying high and selling low. A clear example of this happened in March 2020, when markets dropped sharply due to COVID-19 fears. Millions of investors panic-sold their ETFs, locking in losses and then missing the sharp recovery that followed. Another thing to be aware of, there are now over 4,100 ETFs in the US alone, ranging from broad market funds to highly specialized ones like tech, crypto, or even inverse and leveraged ETFs. While this variety offers choice, it can also be overwhelming, especially for investors who just want simple, long-term exposure. Many newer investors end up chasing whatever sector or theme is trending. But these niche ETFs often come with higher costs, greater volatility, and a higher chance of underperformance if you're not careful. And lastly, there's a technical issue called tracking error, which means some ETFs don't perfectly match the performance of the index they're supposed to follow. This is more common in international commodity or complex ETFs, where price movements can deviate slightly due to trading costs or market structure. So while ETFs are a great tool for long-term investing, knowing how to use them wisely matters just as much as the product itself. So who are ETFs really designed for? ETFs are perfect for hands-on investors who have time to research, who can resist the urge to check their accounts daily, and who understand that more options doesn't mean better results. They're ideal for people who treat investing like a serious hobby and have the discipline to stick to their strategy. Now, if you're someone who wants to set it and forget it, ETFs can be risky, not because they're bad, but because they offer too much control. The ease of real-time trading, combined with thousands of ETF options, often leads to frequent changes, emotional decisions, and costly timing mistakes. For long-term investors, that behavior can quietly eat into decades of wealth-building potential. If you're constantly checking your portfolio and tweaking your ETFs based on headlines or emotions, you're not investing, you're reacting. And over time, that can feel a lot more like gambling than building a future. Now let's talk about index funds, the long-term favorite of Warren Buffett and many financial experts. Index funds are popular for one reason: simplicity. Instead of trying to beat the market, they aim to match it by owning every stock in an index like the S&P 500 or the total US stock market. There's no high-paid fund manager making risky bets, no layers of analysts eating up your fees, just a low-cost, rules-based system that does exactly what it says it will. Most index funds charge between 0.03% and 0.10% annually. That means on a $6,000 yearly investment, you're paying just $1.80 to $6 per year compared to $75 or more for a typical mutual fund. Over 30 years, that small difference could translate into over $100,000 in saved fees and compound growth. Index funds also reduce emotional investing mistakes. You're not making constant buy or sell decisions. You're not watching daily performance. You're just riding the market and letting compounding do the work. And here's the beautiful part. You own everything, so there's no fear of missing out. You can't chase performance because you are the market's performance. There's one thing to be aware of. The S&P 500 isn't as balanced as it used to be. The top 10 companies now make up over 30% of the entire index, with tech giants like Apple, Microsoft, Amazon, Alphabet, and Meta alone accounting for nearly a quarter of your exposure. So while index funds still offer massive advantages, it's good to understand that today's diversified index is heavily weighted toward just a few mega-cap stocks, meaning your performance is more tied to them than you might realize. When you buy an S&P 500 index fund, it feels like you're spreading your money across 500 companies, and technically, you are. But in reality, over 30% of your investment is concentrated in just the top 10 stocks, mostly in the tech sector. That means you're not just buying the market. You're making a big bet on a few dominant tech companies like Apple, Microsoft, Amazon, Google, and Meta. If these companies thrive, so does your portfolio. But if tech faces new regulations or a shift in innovation cycles, it could impact your performance more than you'd expect from a so-called diversified fund. Index funds are low maintenance, and that's a good thing. But for some investors, that ease becomes neglect. They set up automatic contributions and never check in on their portfolio again. They forget to rebalance between stocks and bonds as they get older. They forget to increase contributions when their income goes up. They forget to optimize for tax efficiency. And they forget to adjust their strategy as their life changes. Left unchecked, this can quietly cost you thousands in missed gains, poor asset allocation, and higher taxes. For example, a portfolio that becomes 100% stocks by default without rebalancing may carry more risk than you're actually comfortable with. And during a market crash, that can lead to emotional decisions and panic selling. So who are index funds really best for? Index funds are ideal for investors who want market-matching returns, very low fees, and a low-maintenance approach. If you want to build wealth through systematic investing without becoming an investment expert, index funds are your best choice. But only if you set up simple systems to maintain your portfolio health over time. After years of research and making my fair share of expensive mistakes, here's something most people don't hear often enough. Mutual funds tend to work best for high-net-worth investors, people who can afford the cost of active management, and whose portfolios are large enough that even slight underperformance won't drastically affect their financial goals. But for everyday investors building wealth through regular contributions, the combination of high fees and inconsistent performance makes mutual funds less than ideal, especially if you're relying on those investments for retirement security. ETFs, on the other hand, are fantastic tools for engaged investors, people who actively research, monitor, and stay disciplined through market swings. But for those who want a more hands-off approach, the ability to trade constantly combined with thousands of options can easily lead to poor timing and emotional decisions. Index funds are ideal for long-term investors who want to capture market growth with low cost and low maintenance, while still applying basic portfolio management principles. They're simple, diversified, and efficient. A solid choice for 80% of investors who are focused on building wealth over decades, not reacting to market noise. The truth is, the financial industry profits most when investors are overwhelmed. When you're unsure what to choose, you're more likely to pay more, trade more, and chase advice that benefits someone else. But building wealth doesn't have to be complicated. You don't need a finance degree, you just need a simple system, low-cost tools, and the discipline to stick with it. And if you're wondering what this could look like in real life, how to turn consistent investing into reliable income, watch this next.